In September 2025, Caesars Entertainment was kicked out of the S&P 500, not downgraded, not reshuffled, removed. That may sound technical, it isn't. Companies don't fall off America's top 500 by accident, and when a pillar of the Las Vegas Strip loses its place on that list, it is rarely just paperwork. It is a signal. Since then, revenues have softened. Occupancy has slipped. The stock remains more than 50% below where it traded 2 years ago. And Caesars is still carrying over $12 billion in long-term debt. For a company that controls Caesars Palace, Harrah's, Horseshoe, Flamingo, and multiple major Strip properties, that combination is not routine. It is pressure. And pressure at this scale does not stay contained. So this isn't about one quarter, it is about trajectory. 5 months after losing its place among America's corporate elite, the real question isn't whether Caesars was removed. The question is what that removal revealed. When Caesars was dropped from the S&P 500 in September 2025, it was not a ceremonial reshuffle. The S&P 500 is the benchmark index for the U.S. stock market. Inclusion signal size, liquidity, and institutional confidence. It places a company in the top tier of publicly traded firms. When you are in the index, billions of dollars in passive investment capital automatically hold your stock. When you fall out, those funds are required to sell. That forced selling does not mean collapse, but it does mean contraction. It signals that, relative to peers, something has weakened. 5 months later, Caesars has not returned to the index. That absence matters. Because in a capital-intensive business like casino resorts, perception is leverage. Access to capital is oxygen, and when perception softens, oxygen gets thinner. Then there are the revenue numbers. In the second quarter of 2025, Caesars Las Vegas revenue declined roughly 3.7% year-over-year. 3% sounds small until you multiply it across an empire of Strip properties. At that scale, small percentages translate into tens of millions of dollars. Revenue softness does not just reduce profit, it compresses flexibility. Large resort operators carry heavy fixed costs: staffing, utilities, security, maintenance, marketing, and debt service. Those costs do not automatically shrink when revenue dips, so even a modest decline can ripple outward. Now layer in occupancy. Occupancy slipped about 2 percentage points. That equals roughly 27,000 fewer room nights sold in a single quarter. That is not abstract. That is 27,000 instances where rooms that normally feed gaming floors, restaurants, shows, and nightlife sat empty. Las Vegas runs on density. When density drops, margins tighten quietly. When that tightening persists across multiple quarters, investors stop treating it as noise. They start treating it as a trend. The stock market noticed. Over the past year, Caesars shares have fallen roughly 30%. Over 2 years, the drop exceeds 50%. Markets do not move on nostalgia. They move on expectations. When a company loses half its market value, investors are adjusting their confidence in future growth. Lower valuations restrict options. Expansion plans become harder to justify. Refinancing becomes more expensive. Equity raises become more dilutive. Risk tolerance narrows. And in Las Vegas, a city that thrives on reinvention, reduced risk tolerance changes behavior. The Strip does not reinvent itself cheaply. It requires capital. And capital follows confidence. Then there is the leverage. Caesars is carrying approximately $12.3 billion in long-term debt. Debt can amplify success, but it also magnifies softness. Interest payments do not decline when visitation dips. Debt service does not pause when occupancy slips. Those obligations are fixed. Tourism demand is not. Las Vegas is cyclical. Consumer confidence shifts. Feeder markets fluctuate. International travel rises and falls. When revenues grow, leverage looks manageable. When revenues soften, leverage becomes exposure. It reduces margin for error. It means that what would otherwise be a mild slowdown becomes something more consequential. Not dramatic, but constraining. And constraint changes strategy. Caesars has responded the way leveraged companies often do. It has raised liquidity. Over the past couple of years, the company sold notable assets, including the World Series of Poker brand and the Lion-Q Promenade. These were not background holdings. They were recognizable revenue generators. Asset sales provide breathing room. They strengthen the balance sheet in the short term, but they also reduce long-term income streams. You are trading future revenue for present stability. This does not signal collapse, but it does signal adjustment. And when asset sales coincide with stock pressure and revenue softness, investors ask a different question. Is this optimization, or is this defense? Timing matters. Not all of this pressure is internal. Tourism across Las Vegas showed softness through parts of 2025. In June alone, visitation dipped roughly 11% year over year. An 11% decline in a city built on volume is significant. Hotel rooms feed casinos. Casinos feed restaurants. Restaurants feed nightlife. When visitor flow slows, the entire chain tightens. For Caesars, heavily concentrated on strip tourism, that tightening is direct. Mixed months create uncertainty, and uncertainty is uncomfortable in a leveraged environment. Then there is value perception. Room rates have climbed. Resort fees now exceed $50 per night at many Caesars properties. Parking charges have normalized. Food and beverage prices have risen sharply. Individually, these increases seem incremental. Collectively, they change psychology. Las Vegas once marketed accessible luxury. When add-ons stack and bills climb, perception shifts. Guests may still come, but they adjust. Shorter stays, tighter budgets, more comparison shopping, less impulsive spending. Revenue doesn't collapse. It erodes gradually. Gradual erosion is harder to detect and harder to reverse. Consumer confidence adds another layer. Discretionary travel depends on optimism. When households feel uncertain about income, inflation, or job stability, optional trips get postponed. California, a major feeder market for Las Vegas, has experienced its own economic fluctuations. Regional travelers can cancel more easily than international tourists. That flexibility works both ways. Strong sentiment drives quick bookings. Weak sentiment drives quick cancellations. For Caesars, small behavioral shifts across large volumes compound quickly. And in a leveraged model, compounding softness matters. International travel has also shown uneven signals. Visitors from Canada, Europe, and other markets often stay longer and spend more consistently midweek. When those segments soften due to currency shifts or economic headwinds abroad, occupancy consistency weakens. Domestic travelers don't always replace international ones one for one. Hotels either accept lower occupancy or discount to fill rooms. Both paths. Pressure margins. In isolation, international softness is not catastrophic. But layered on top of other headwinds, it adds friction. And friction accumulates. Competition has expanded, and regional casinos have grown aggressively. Gaming access is now widespread across the United States. Online sports betting and digital casino platforms let customers gamble without boarding a flight. Las Vegas still offers spectacle, but gambling exclusivity has diminished. For Caesars, which operates both physical resorts and digital platforms, this creates tension. Digital growth can supplement revenue, but it does not replicate the density economics of a full resort stay. As gambling disperses geographically and digitally, sustained high-margin occupancy becomes harder to guarantee. Not impossible. Harder. When demand softens, companies discount. Caesars has leaned into promotions with bundled packages, advance booking incentives, and citywide sales. Discounting fills rooms, but it compresses margins. Frequent promotions retrain customers. Guests begin waiting for deals, and yield declines. In a low-debt model, that is manageable. In a high-debt model, it narrows breathing room. Promotions manage pressure, but they do not eliminate it. So, where does this leave Caesars? Not collapsing, not thriving, operating under constraint. If demand rebounds strongly, through conventions, events, or improved consumer sentiment, leverage becomes manageable again. If recovery is partial, constraint persists. And constraint changes behavior. Capital expenditures slow. Risk appetite narrows. Operational discipline tightens. When one of the Strip's largest operators begins tightening, competitors notice. Pricing strategies adjust. Reinvestment cycles shift. The Strip does not implode overnight, it recalibrates, and recalibration rarely announces itself loudly. It shows up in margins, in incentives, in smaller decisions that compound over time. 5 months after losing its S&P 500 status, Caesars remains operationally intact. The lights are on, the rooms are booking, the casinos are active. But the math has grown less forgiving. Revenue softness, occupancy slips, stock compression, $12 billion in debt. None of these guarantee decline. But together, they reduce margin for error. And in Las Vegas, margin for error is everything. Because this city runs on confidence, and confidence, once thinned, changes behavior. The next year will determine whether this was a cyclical dip, or the beginning of a longer recalibration. Either way, one thing is clear. Caesars is no longer operating from unquestioned strength. And when a pillar shifts, even slightly, the Strip feels it. The only question is how far.